By the end of this video, you'll understand why Tesla's stock price makes absolutely no sense. And yet, paradoxically, why it might just double in the next 12 to 18 months. We'll uncover the hidden forces driving Tesla's valuation, explore the Elon factor, and reveal a surprising truth about the company's future that most investors are overlooking. As we unravel the Tesla paradox, it's time to separate hype from reality and discover if Elon Musk's brainchild is a ticking time bomb or the investment opportunity of a lifetime. Speaking of opportunities, our teaching portfolio is up over 80% this year alone. And you might not care about that, I get that. But if you want to learn how we did that, and how we continue to do that, I'm hosting a 2-hour free beginner trading bootcamp on Tuesday, 8 p.m. Eastern time. So secure your free spot at felixprehn.org/bootcamp. Now let's dive into the numbers game that's got Wall Street scratching its collective head more than Winston scratching his ears. We're talking about the price to earnings ratio, or PE ratio, the financial world's equivalent of a car's miles per gallon. Imagine you're driving a car and instead of the speedometer, you've got a PE ratio meter. For most companies, this meter hovers around 20 to 30, but Tesla, it's like the speedometer has gone haywire, spinning past 100, 200, even 300 at times. Let's put this into perspective. While the average PE ratio of the S&P 500 is around 25, traditional car makers like Ford and GM hover around 6 to 10. Tesla's PE ratio has been known to skyrocket past 300. It's like comparing a Formula One car to a family sedan from the 80s. Even Winston, my four-legged financial analyst, is baffled by this. He's been sniffing these numbers out for days, and all he's got to show for it is a confused whimper. So what makes Tesla's valuation stand out like a neon sign in a library? Is it just hype, or is there method to this madness? You see, Tesla isn't just any car company. It's a tech company, an energy company, and the car company rolled into one. So it's like trying to value a Swiss Army knife using only the metrics for a button. But there is more to this story than just numbers. There is a certain Musk factor at play. And that, my friend, is where things get a little more interesting. So let's address the elephant in the room, or rather the Musk in the market. Elon Musk, Tesla's enigmatic CEO, has become synonymous with the company's brand. But how much does this presence actually impact Tesla's valuations? Financial analysts on Wall Street have coined the term Elon premium to describe the perceived additional value that Musk brings to Tesla. Some estimates suggest this premium could account for as much as 20 to 30% of Tesla's market cap. Consider this. When Musk tweeted about taking Tesla private in 2018, the stock jumped 11% in a single day. Conversely, when he sold $8.5 billion worth of Tesla shares in 2022, the stock dipped 12% in just 2 days. Gene Munster, managing partner at Loop Ventures, puts it succinctly: Elon Musk is Tesla's chief engineer, CEO, and chief innovator. The market has concluded that's worth a lot. But it's not just about Elon's personality. His vision has driven Tesla to innovate at a pace that leaves traditional car makers in the dust. From over-the-air software updates to advanced battery tech, Tesla is consistently pushing the envelope. However, this Elon premium is a double-edged sword. While Musk's ambitious projections often boost investor confidence, they also set high expectations that Tesla must meet to justify its valuation. The result: Tesla's stock exhibits significantly higher volatility, that's the crazy up and down, than both tech giants and traditional car makers. So it's a roller coaster ride that's not for everybody. As we continue to unravel Tesla's valuation puzzle, we must consider how the company's growth expectations align with his Elon premium. Are investors banking on Musk's vision, or is there more to Tesla's sky-high valuation? Let's dive into the heart of the Tesla valuation debate. The company's earnings per share growth potential and its sky-high price-to-earnings ratio. It's a tale of two perspectives. Some social media pundits and traditional analysts are often at odds about this. Tesla's earnings per share, EPS in short, has seen remarkable growth in recent years, from 21 cents in 2020 to $4.30 last year. That's almost a 2,000% increase in just 3 years. But this is where it gets contentious. On Twitter, you'll find fervent Tesla supporters projecting continued exponential growth. Some are forecasting a quarterly EPS of $1.46 by next year or the year after, which would represent a 250% increase from the current 42 cents. Possible or fiction? Well, traditional analysts are a lot more conservative than the Twitter crowd. They point out that Tesla's EPS growth has already begun to slow, with only an 18% increase from 2022 to 2023 compared to triple digits the year before. Now let's talk about that. That PE ratio, Tesla's forward PE ratio, is often hovering around 70, 71 times earnings. The auto industry is closer to 10. And the bulls will, of course, argue that it's justified because the company has that growth potential, the tech edge, the robots, the energy, all that good stuff. However, Wall Street is much more cautious on this. They're saying that as a company grows larger, it historically is unusual for PE ratios to remain this high. They argue that as Tesla's growth will inevitably slow, their words not mine, its PE ratio should naturally compress. The crux of the debate is this: if Tesla can achieve that $1.46 quarterly earnings per share number and maintain its 70x PE ratio, the stock price should double. But that's an if that requires continued execution and market optimism. So are we going to get that? Is Tesla going to be able to maintain this historically high PE ratio? Well, the premium isn't unprecedented in the tech sector. Companies like Amazon and Netflix have sustained high PE ratios during periods of rapid growth. However, Tesla's case is rather unique as they straddle the tech and the automotive industries. Historically, as companies grow larger and their growth rates slow, their PE ratios tend to compress. Look at Apple or many other companies out there. And this phenomenon, known as multiple compression, poses a challenge to the assumption that Tesla can maintain its current valuation. So what makes Tesla different? Well, the Tesla polls will say that the high PE ratio is there because of the potential for autonomous driving, energy storage, and other emerging technologies. And those things justify the premium. They view Tesla not as a car company, but as this tech conglomerate that happens to make cars. The skeptics, of course, will say Tesla's revenue base will expand, yes, but the growth rates will not be possible to achieve because once you are a certain size, you can't double your business. Apple isn't going to double its business, right? So will the law of large numbers inevitably catch up with Tesla and make it therefore difficult to outperform the market? Well, it's worth noting that there are other high-growth companies that have managed to maintain very elevated PE ratios for very long periods of time. Amazon, for instance, traded in triple-digit PE ratios for years. That is, of course, the exception rather than the rule. So your question should be, is Tesla the exception? Well, let's examine the potential catalyst that could propel Tesla's growth and therefore stay in the Amazon level of valuations. First, Tesla's pipeline is brimming with promising developments. The Cybertruck is now the best-selling EV truck in the US. Took them a while to get it on the road, but it's already overtaken Ford's F-150. Full self-driving, if and when perfected, this could revolutionize transportation and create a massive new recurring revenue stream. Think Uber on speed, because you don't have to pay drivers. So it can drive a lot more and it'll be a heck of a lot cheaper to run. Energy storage. Tesla's Powerwall and utility-scale batteries could capitalize on the global shift towards renewable energy. The $25,000 new Tesla model, this could dramatically expand Tesla's market reach and make it a much more affordable model, much higher volumes. And then we got robo-taxis, which is sort of a combination of the full self-driving and the cheap model. You put the two together, you go and buy yourself a Tesla, and rather than having to pay, $700 a month to release that car, maybe it'll pay you $700 a month for the privilege of owning the car. That'd be a rather nice change, wouldn't it? And then, of course, we got Optimus robots, and I've made some videos on that in the past. if Tesla captures just a small percentage of the global robot market, that could be a far, far bigger and more profitable business than cars. However, these catalysts come with challenges. Production ramp-ups often face delays, FSD faces regulatory hurdles, and there will be competition. So we need to delve into market psychology here. Tesla stock often behaves more like a tech stock, an automotive stock, reflecting investor belief in its innovation potential. And this perception creates this self-reinforcing cycle. High valuations enable Tesla to raise capital cheaply, funding further innovations. So the story stock phenomenon really plays a crucial role here. Many investors buy into Tesla's vision of a sustainable energy future and often prioritize potential over current fundamentals. So it's kind of like a very, very large startup or a very, very large company that has very promising startups within it. And that's what leads to the volatility that we see, because the stock reacts strongly to news that either supports or challenges the narrative and the expectations. As we discussed earlier, Elon Musk's public persona significantly influences this psychology. His bold predictions and active social media presence can sway investor sentiment rapidly, contributing to the zigzag in the stock. And it's that psychological factor that creates this valuation conundrum. Tesla's market cap often exceeds that of multiple major car makers combined, but then you don't see Mercedes or BMW being involved in energy or robotics businesses, right? Or full self-driving. So as we zoom out from Tesla's specific case here, let's consider what this valuation puzzle tells us about the evolving nature of financial markets and investing. Tesla's valuation isn't an isolated phenomenon. It's part of a broader trend where traditional valuation metrics are being challenged by companies in rapidly evolving industries. Think Amazon and e-commerce, Netflix and streaming, or Uber and ride-sharing. Although, watch out, Uber. Over the past decade, we've witnessed a seismic shift in market composition. In 2011, oil and gas companies dominated the S&P 500. Right now, tech giants rule the roost. And this shift reflects a fundamental change in how markets value potential over current reliable profits. Tesla's case exemplifies this trend. Despite producing far fewer cars than traditional car makers, its market cap has often exceeded that of Toyota, Volkswagen, and General Motors combined. And this valuation isn't about cars, it's about the perceived potential of Tesla's tech ecosystem. Traditional metrics like PE ratios or discounted cash flow models struggle to capture the potential of paradigm-shifting technologies. How do you value a company that's not just disrupting an industry, but potentially creating entirely new ones? If you'd valued Amazon as an online bookshop back in whenever they started, you would not have captured the potential of cloud computing, advertising, robotics, and everything else that they're up to. Some market veterans argue we're in a new era where traditional valuation methods are obsolete. Others caution that fundamentals always matter in the long run. I would say the truth lies somewhere in between. I remember working for a .com startup in 1999, and our valuation metric was cash burn rate, as in how much cash could we possibly spend? And that was obviously idiotic. So I wouldn't throw out valuation metrics completely. It's just the challenge with fast-growing innovators is that they don't really capture the potential future. So what's the answer to is Tesla fairly valued or undervalued? Well, the answer likely depends on Tesla's ability to deliver on its ambitious goals and the market's continued faith in that potential. Whether Tesla can justify its valuation or even a much higher one will remain an open question. The company's futures hinges on its ability to deliver on ambitious goals. Personally, my money is on Elon. Speaking of money, for years I've been trading for a couple of hours a week following a fairly simple 3-step system. If you want to learn that system, because that system has got us up over 80% so far this year, then come and join my free beginner bootcamp on Tuesday evening at felixprehn.org/bootcamp. And for 2 hours, I will teach it to you. I will show it to you. I will show you absolutely everything we do. I'll show you every trade I've done this year. If that sounds fair, go and sign up. The link is down below. And I thank you for tuning in. I thank you for watching. If you got some value out of this video, share it with a friend. The chance of a hard landing just doubled in the last 5 days. By the end of this video, you will know how a hard landing recession would impact your favorite tech stocks, including Tesla, Palantir, SoFi, and PayPal.